Today we're going to hear from Dana Samuelson. He's president of American Gold Exchange, but as you'll soon find out, he knows a lot more than just gold. All right, Dana, thanks so much for joining us on the show. Super excited to talk to you about inflation, U.S. debt, and gold.
Hi, Chad. It's great to be with you. I appreciate the opportunity to speak with you and your people.
Yeah, well, this is good. The first time, actually, I think 2 years ago when we were in Belize, and you brought your quarter example here, and it's an interesting story you shared us because it's actually two quarters, right? One from 1964 and the other one's from 1980. And any of the astute listeners know the difference between the two. And so it was interesting because he said, hey, 1964, that quarter was made out of silver and it could buy you a loaf of bread. And then they stopped making them out of silver. They started making them out of copper and nickel.
Right.
And it, the price of the dollar, so to speak, has gone downhill. The purchasing power has gone down. So now that quarter won't do anything for a loaf of bread. But that 1964 quarter, which is made out of silver, can still buy you about a loaf of bread.
That's right. That's right. It shows you the purchasing power of silver over the last, 40 years, 50 years.
Yeah.
It's held up where, the fiat currency that has nothing in it, fiat money that has no intrinsic value, well, it has no intrinsic value. So gold and silver tend to hold their purchasing power over time. And they do especially well in an inflationary environment, which, of course, we're in one of the hottest inflationary environments we've seen in 40 years right now.
Yeah, so this is great stuff. I really want to dive into it. You'll be proud to know that I actually keep this on my desk as a reminder. It's literally one of the two things I have, propped up under my monitor. So I do appreciate that little token of reminder of what real money is.
I'm honored that you have it.
It's still there actually, and I have two now, right? Because you gave us another one this last year, so I got two in the same spot. But so one of the presentations that you recently gave at the Real Estate Guys, I think we were in Vegas for that one. I thought really summarized well kind of where we're at today with what the Fed's trying to do to tame inflation, and you have a wealth of knowledge, way more than just gold. And you're president of the American Gold Exchange, and you've had a 40-year history in precious metals like that. You really know really well. But that presentation you put together, I think, really helped open my eyes to the broader picture that we always hear about in the circles and different seminars that we're at with the Real Estate Guys. And I was hoping maybe we could go through an abridged version of that presentation that you gave, kind of talking about those three categories. Does that sound feasible?
Yeah, that sounds great. Yeah, so I've been in the precious metals business since 1980 at the tail end of the last inflationary cycle. And the economic forces, inflation, low inflation, interest rates, strong economy, weak economy, debt, these things all affect precious metals. So I've been a student of economic activity for 40 years, which is how I've acquired some of this other knowledge on top of my nerdness, which is just being a precious metals guy and a vintage coin expert.
Well, I'm a structural engineer, so we'll share that nerdness together. It's all right. It pays the bills. So cool. So all right, well, I'm going to pull up some of your charts, and then we can just go through those. And if there's things to add, please feel free. But let me pull that up and share my screen here. Okay, well, this is a good place to start here, Dana, because it's got all your contact information that you already said I could share with the listeners in case they need to get a hold of you. So there it is, the American Gold Exchange. And let's dive into the meat of this thing and find out what's going on.
Right. So I put together a presentation on inflation then and now, comparing what happened during the last inflationary cycle, which was basically 1965, 66 to 1981, and where we are today, the cost and effect of inflation, and how gold tends to react. And it's actually a bit undervalued right now for reasons we'll get into. So one of the things that's happened is the dollar has lost its purchasing power gradually over a very long period of time. Now, from ancient times all the way into the 1930s, gold and silver were both money and currency. Now, money is something that has intrinsic value, and currency is something that is a good medium of exchange. And gold and silver have been both for most of man's time on the planet. Because gold and silver are malleable, they're easy to make coins into, and they have perceived value. So up until 1933, our currency was gold and silver and paper, which came about in the late 1800s. In 1933, Franklin Roosevelt took the gold out of the currency so he could print more money, kind of like what we've been doing today, only we don't have gold-backed currency. So that was when the first major change happened. And that's when the dollar really started to lose purchasing power relative to its intrinsic value, which became nothing, except gold still backed the dollar, only not in its currency. It was backed by gold in Fort Knox until 1971, when Richard Nixon was forced to take the US off of the gold standard because we started to print more money than we had gold to back it in Fort Knox. And he devalued the dollar 10% overnight and unpegged the dollar to gold. And that's when the real skid began, and the dollar continued just to lose purchasing power. So if you have inflation, that's basically inflation is what it is. And it's 2% a year. You don't really feel it that much. But when you get into a period like we did between 1970 and 1980, you see how much the dollar lost during that period. That's when inflation was hot. Since then, inflation's been tame, but now we're going back into another high inflationary period. So $1 a year ago, to us, it was $1. Today, it buys 91 cents worth of purchasing power. It's lost that much in a year to inflation. And like I said, when inflation's 2% a year, like it's been from about 2013, 2014 to 2019, you don't really feel it, but suddenly everybody's feeling it in their pocketbook. So this is the historical loss of purchasing power of the dollar due to inflation over time.
Okay.
And
maybe
it's getting worse.
Yeah, and maybe just for perspective and maybe a reminder, I'm sure some people listening aren't aware that at some point, U.S. citizens were not allowed to have gold at all, right? They confiscated all the gold for a period of time. When was that again?
Right. So when Roosevelt took the gold out of the currency in 1933, gold was also illegal to own. That's how they really got it all out. And in 1933, let me back up. Between 1850 and 1933, the gold price was pegged internationally at $20.67 an ounce. Then they confiscated it all. Between 1933 and 1935, nobody could own gold, and that continued until 1974. But by 1935, the gold price was pegged internationally at $35 an ounce. It went up 75% once the government got its hands on it, right? Yeah. And my boss in 1981, Jim Blanchard, was the man who was most responsible for the private relegalization of gold in 1974. When Nixon took us off the gold standard, he started a grassroots movement to re-legalize the private ownership of gold, and he was successful in 1974. And I was lucky enough to go to work for Jim in 1981, and I worked for him for 10 years. He was an amazing individual,
Well, that's so for almost 40 years, U.S. citizens could not hold gold personally.
Correct. Now, you could own gold in Europe and Asia. They never did that. And we still had silver in our currency until 1964, like those quarters. And there's also dimes and half dollars. They took the silver out of the money in 1965. But yeah, it was illegal to own.
Wow.
Illegal to own.
Amazing.
I know.
That's unbelievable, but it pays to pay attention to history. I'll say that much.
Right. So this is a chart of inflation, the consumer price index. Both the red line is the headline CPI number, and the blue line is the core number. And this goes back to 2000. On this chart, you can see the green line is the Fed's 2% personal consumption expenditures line, where they want to hold inflation at. And post the financial crisis of 2009, you can see that everything was pretty tame. But since 2021, inflation has just taken off like a rocket. And that's primarily because during COVID, we closed the economy. We told a lot of workers that produce things to go home. Then we gave them a bunch of money and they spent it in a supply deficit environment. So too much money was chasing after too few goods, and that's helped to get inflation going. But it's not just in the US, it's a worldwide phenomenon now. Inflation's all around the globe at 7, 8, 9%. And we haven't been in this kind of an environment since the late 60s into the mid and late 1970s. And once inflation, the genie gets out of the bottle, it's really kind of hard to contain, because the longer it persists, the stickier it gets. And we're seeing that now in wages and in rents and in housing prices. That's where inflation gets sticky. You give somebody a raise or you raise the rent, a year later things calm down. You really don't get that money back. You can't ask for that wage increase back, or you don't really lower the rent. So once this gets entrenched like it is now, it can really be a problem and can last for much longer than people think.
Wow.
Yep. And I've followed the financial websites a lot. Bloomberg's one of the ones I follow quite a bit, and everybody's feeling it in their pocketbooks right now. And it's because of utilities, gasoline, food prices are way up. The war in the Ukraine took what happened from COVID and amplified it. It's like putting a magnifying glass on the problem, because Russia is the number one exporter of oil. The Ukraine is the number 3 exporter of corn and wheat. They both make fertilizer. So this is the stuff we need to live by. And that has caused food prices to really surge. You've seen some headlines recently about some of these ships full of grain finally getting out of the Ukraine. And this is the real problem with regard to the Ukraine. They supply food to Africa, Egypt. And if they don't get last year's grain production out of the silos and the storage bins now, they won't have any place to put this year's production, which is coming, the crops are coming to harvest. And of course, this year's production is impaired because of the war over there.
Yeah.
So they've got to get that stuff out so they have room to put the new stuff in, or else the situation is going to get even worse. And everybody's going to feel higher food prices throughout the winter, I think. It's really not a good situation. So this is inflation in the CPI in red, and the blue in the Fed funds rate from 1967 to 1995. And this is probably the most important thing that I can talk about today with your people.
Okay.
Inflation really took off in the late 60s for 2 reasons. We spent more money than we had the ability to grow economically because of Lyndon Johnson's Great Society program, Medicare and Medicaid, and the Vietnam War. Then we had an oil shock in 1973 and another oil shock in 1979. But the point I really want to make here is this. There were 3 big inflationary waves over 15 years, and each successive wave was bigger than the previous one. During the first one, Nixon became president, and as we talked about a minute ago, he took us off the gold standard in 1971. So that first wave kind of got tamed down, but he also was running for re-election in 1972. So he didn't really want to have a weak economy. So how do you not have a weak economy? You stimulate it. You lower the Fed funds rate, right? And that's what happened. So they didn't really get inflation in check. We had a second wave because of the oil shock of 1973, Arab oil embargoes, the oil price doubled. And then that rolled over and tamed, but then inflation took off a third time and really got red hot, all the way up to 16% in 1980. Paul Volcker became Fed chairman in July of 1979 when the Fed funds rate was 7.5% and inflation was about the same, maybe a little higher. He got the Fed funds rate up 10 percentage points in the first 6 months of his chairmanship. And that's that spike all the way up to almost 18%. but it didn't kill inflation. They dropped the Fed funds rate back down to 9%, and it didn't take care of the problem. So they punched it back up to 19%, the Fed funds rate, and they kept it up there. So what had to happen was the Fed had to get the Fed funds rate over the inflation rate to cause enough demand destruction. And that's what they're trying to do, is create lower demand by making things more expensive. That's how they tamed it. The first half of that chart, the Fed funds rate and the inflation chart lines pretty much follow each other. The second half of the chart to the right, you can see how much above the inflation rate the Fed funds rate was for the next 15 years.
Yeah, and one of the things I find interesting and it's tough to capture in this chart, to me, is the other side of the equation. And you briefly mentioned it during COVID, is the supply side of things. And if you have supply chain issues and you're undersupplied and your demand is high, that's going to make pricing go up. And the Fed doesn't have direct control over that. So isn't it going to be a little bit more challenging for them to get this round of inflation under control since we have supply chain or supply side issues?
Yeah, I mean, we had supply issues during these 2 waves, oil supply issues, because we were denied oil. That's really the only thing. Today, the supply side issues are much more widespread and broad and deeper. And the Fed doesn't have a toolbox for that. They can slow down demand, but they can't fix the supply problems. And you've got to put it into this context too. The last 20 years, because of globalization, we've seen prices for labor and prices for goods do nothing but go down for 20 years. And by about 2017, 2018, 2019, just-in-time inventory systems around the world were all humming about as efficiently as they ever could. And then COVID came and broke that system. Then the war in the Ukraine amplified the problems with some of the supplies, food and energy, basically. And now what do we have? We have more tension in the world than we've had. China versus the US. You saw the problems in Taiwan last week with Nancy Pelosi going over there. And the war in Russia is creating a bifurcation in Europe that's much harder than before. So we're not going to get back to that really humming just-in-time inventory thing that peak globalization. We're in a deglobalization period now, which could last for a long time. And this is fundamentally inflationary too, which is why the Fed doesn't have the right toolkit. You know, they have one component of 3 that they really would need, which is to fix supplies and to help make the world a tamer, more agreeable place. So they really can only work on the demand side by raising the Fed funds rate.
Wow. Okay.
So this chart shows you how tame everything was from 1995 all the way to 2022. And this chart's a little old. It's a month old. You know, the inflation rate's now at 9%, and the Fed funds rate is at about 2.75%. So the Fed's 6% behind the curve right now, with the Fed funds rate at 2.75%. That means if inflation doesn't come down meaningful, and it probably will to some degree, but that doesn't mean it's going to come down all the way back to 3 or 4%. I expect it to be 5 or 6, maybe 7%. The Fed may not have the political will, and the U.S. economy may not have the financial will to get the Fed funds rate high enough to really tame inflation. And if they don't, the chances for us to have some of these waves that go bigger and bigger really increase a lot. And I follow a couple of economists. One of them's Lacey Hunt, who happens to be here in Austin, Texas, where I'm from. His company is Hoisington Asset Management. Bill White is an economist, and Tom Honig was a Fed chairman, and one of the only dissenters during the QE in 2010 on the Federal Reserve Board. They all said the same thing recently in print. If the Fed doesn't take care of inflation in this cycle, the prospects for the U.S. economy and inflation going forward become much, much worse. So these are really smart people that have tons of economic experience that I don't have, but I respect what they say. And so we're really at a pretty critical juncture right now.
And which cycle are they referring to?
Well, if this first bout of inflation, if they don't
Oh, so we don't have three
further,
peaks
we're going
again.
to have further waves, and the waves could be bigger as they go
Got it.
forward.
Got it.
So
Well,
this could last for, the last three waves took 15 years. That's how
yeah.
long it is. Now,
Wow.
things happen faster these days, so it could be 5 or 10 years, but they could be more violent because of how things react these days.
Well, I'm sure we're gonna get to the other headache they're gonna have, which is the U.S. debt. I think we'll probably end up getting to that as well, right?
Yeah, we'll talk about that in a minute. But this is really why it's inflation's hurting everybody today. It's because we've got electricity and utilities, gasoline and other fuels, and food at home are all rising at the same time, 10% or more. This is the only time since 1980, all three of them have been doing that at the same time, which is why it's hitting us everywhere we go. And that's why it's so severe right now in our pocketbooks, is because everywhere you look and everything you need, utilities, electricity, gasoline, natural gas, bread, meat, everything, everywhere you look, prices are up double digits.
Yeah.
And we haven't been in this same period since 1980. We've had other periods where one or two went up that much and came back down, but not all three at the same time.
Yeah, I like the title of that, Inflation Frustration, although it's probably understated, right?
Yeah.
Jeez.
So the next part is about talking about the cost and effect of inflation. And again, this is a Bloomberg headline. The cost of taming inflation will be exorbitant. And that's primarily because of the Fed having to raise Fed funds aggressively when we have more debt than we've ever had. Now, one of my business partner, Dr. Bill Musgrave, who's a PhD, I asked him, Bill, what's a good analogy for inflation right now in the U.S. economy? When we have zero interest rates, like the Fed has had the Fed funds rate at for most of the last 7 or 8 years, that's not a healthy economy. If you have to stimulate the economy continually, it's like a patient that's on life support, right? Because that's what it really is. We like it because, mortgages cost less. Inflation has been low, but suddenly the patient's blood pressure starts rising. That's inflation, right? So what do you do to fix the problem? You take the patient off of life support. And that's what's happening with the U.S. economy.
Ouch.
Exactly. So this shows the difference between inflation back in 1980 and inflation today. Back then, in 1980, when the Fed got the Fed funds rate to 18 and 19%, and interest rates were higher, our debt to GDP ratio was 31%. And most of our debt was in 20, 30-year treasuries, which don't, if they raise the rates for a couple of years and spike them way high, it's not going to really make that big of a difference because most of the debt's long term, right?
Okay.
Today, our debt to GDP ratio is 4 times more than it was during the last inflationary cycle 40 years ago at 125% of debt to GDP. And most of our debt is short-term notes, 3 to 5 years. So if the Fed is forced to raise interest rates, and they already have, and they're talking about getting them to 4.5% next year, which is still anemic if inflation's 6, 7, and 8%, the debt service is going to jump dramatically. Now, right now, we spend 700, 800 billion a year on our military budget and our about 500 billion a year on our debt service at $30 trillion of debt with interest rates at under 2%.
Okay.
Now you take that rate up to 5 and 6%, 7%, the interest alone on our debt could be 1.5 trillion, more than our military spending. Wow. Right? And you've been on the aircraft carriers, you know what those things cost, right? This is crazy. And this is a debt trap. It really is a debt trap.
Yeah. I mean, it really puts the Fed between a rock and a hard place because they're well aware of, the cost of the U.S. debt. And it's almost like trying to pick between two poisons, right? Whether to really try to get ahead of inflation, which, like you mentioned earlier, they're only controlling one of three levers, and they try to use the lever they've got, which is the Fed funds rate. Meanwhile, putting our debt servicing for the U.S. debt through the roof.
Very possibly. They know it. They're
Yeah.
right between a rock and a hard place, and they almost have to kill the economy to try and tame inflation, which is why I think that, the prospect of us being in a recession, technically we're really already in one with 2 quarters of negative growth, but they're changing the definition on us a little bit right now.
Yeah. Well, I'm guessing that I'm talking to a hard asset gold guy, and at some point you're going to give us some safer solutions to weather these storms that are coming at us.
Well, we know what worked last time.
Yeah.
So this is a chart of our debt since 1993, and really the point here to make is it's just gone almost vertical. And when things go vertical, they can't stay that way. Something has to give. The big picture here, though, is we had $5 trillion of debt in 1996, and it took us 200 years to get to 5 trillion in debt. And now it's less than 30 years later and worth 6 times that amount.
Wow.
6 times that amount. And that's really where the debt trap is. Our debt has just surged so much relative. It's 150% of our GDP. Our GDP is about 20 trillion a year.
Yeah.
So, it depends on how you measure GDP. Now, this is an interesting table that I made because I wanted to compare the US economy and our debt to GDP ratio to other economies. So these are the top 10 economies by GDP in trillions. The US is number 1, China's number 2, Japan's number 3. But really, the point that I want to make is that Japan has been in stagflation for about 20 years now, where they have low growth and not really high inflation because they're pretty self-contained, but their debt to GDP ratio is 256%. So it takes 2.5 times a year, 2.5 years of their economy to pay for the debt that they have, their entire economy. Italy's number 2 at 155% of debt to GDP, and the US is third at 134%. And what we've seen over the last 6 months is the Japanese yen has cratered relative to the dollar, and the euro has cratered relative to the dollar to 20-year lows, primarily because our interest rates are higher, but also because they have greater risk in their bond markets. And we saw some abnormalities in the Japanese and the Italian bond markets when we were on the Summit at Sand in June. Both of their yields spiked because investors dumped Japanese and Italian bonds to move into the US economy because we were paying higher interest rates, and the risk here is perceived as less. So that spiked the dollar. We'll talk about that in a minute more, but you can't have economies don't grow when they have debt to GDP ratios of 100% or more for 5 years or longer. They don't grow at more than about 2 or 3% a year. If you look at our GDP over the last 10 years, our GDP has been about 2.7, 2.8% on average. We had a spike in GDP last year, but that's because so much stimulus went into the economy, right? An abnormal amount. And now we're going to revert back to the mean, and we're actually in negative growth right now. This is a bad economic equation. And that shows you the dollar, how much it spiked. In June of 2021, the dollar, this is the dollar index, which is the dollar measured against a basket of other currencies, which is the yen, the euro, the Swiss franc, and the British pound. And the dollar was about 90 on the dollar index, and it's got all the way up to 108. And that's because of our interest rate differential. We just pay more on our debt today than the other countries do. The ECB just raised their interest rate the other day from minus 50 basis points to 0 for the first time in 11 years, right? And the Japanese have been holding their bond yield at 0.25% over the last couple of years. because the Bank of Japan is buying the Japanese bonds. So they're self-financing their own debt, which is MMT, stuff, which is kind of crazy.
It
So the
doesn't sound
dollar,
sustainable.
yeah, the dollar has spiked, and this is not. It's good for us in the short time because now the dollar's on parity with the euro. It's the 20-year high against the euro and the yen. So you can go to Japanese cheap, or you can go to the Europe for a lot less than you could 2 or 3 years ago. But this creates imbalances within the world economies, especially in smaller countries that borrow debt in dollars. And now they have to pay that money back, not only with interest, but in dollars that cost a lot more relative to their own currency. And this is when things start to break. So it really puts pressure into the financial system. So this is an example of the blood pressure rising within the financial system.
Is there something like a takeaway you have when you look at the 50-day moving average versus the 200-day moving average for the dollar?
Well, all markets, we look at them that way. Basically, these define trend direction. So when you see the left-hand side of the chart, you can see the red line is over the blue line, which is the 200-day is above the 50-day. That means the market's going down. When they cross, that's called a golden cross, and that means the direction has changed and can start to move up again. So when the short-term average moves up over the long-term average, that usually is a trend shift, and vice versa. When the long-term average moves over the short-term average, that means usually the market's going down. They call that the death cross. So golden cross and the death cross. And this is just a way to follow market trend direction.
Got it. Okay.
So, I'm a precious metals dealer. We're a physical national mail order company, and gold and silver are a great way to have some of your money out of the banking system. They usually do very well during inflationary times. There's no counterparty risk. They have instant liquidity. Russell Gray, one of the real estate guys, has talked about how he got into a liquidity trap back in 2009 because he was over leveraged and couldn't borrow money because the system seized up. So if he had had some gold or silver as part of his financial portfolio, he could have created some liquidity for himself at that time when he couldn't borrow money. So that's what gold and silver are good for. And when the economies of the world are doing great, gold and silver prices can be pretty boring. Between 1971, when Nixon took us off the gold standard, gold was $41 an ounce. By 1980, during that massively inflationary period, it was $800 an ounce. It went up 20 times in value.
Wow.
From 1983, 84 to 2005, you could have slept, gold was between $300 and $500 an ounce. It was boring for me. But once we went into deficit spending following the Iraqi war and the financial crisis hit, gold went from about $500 an ounce all the way to $2,000. When we got into traction following economic traction, 2013, gold came back down to about 1,000, held under 1,350, and now it's surged back over all the way up higher over to 2,070 an ounce. Today it's about 1,775 an ounce, 1,795 an ounce. Every time gold resets, though, it tends to reset higher.
Got it.
That's what you have to think about. It's not going to make you rich, but it might help you really during times of crisis preserve and protect your wealth. So this is a US dollar index chart. Again, same chart we looked at a second ago, but gold and the dollar tend to trade inversely to each other. The dollar goes up, gold tends to go down, and vice versa. And that's because most of the gold buying is not in the United States. India and Asia buy about 4 to 6 times the amount of gold on an annual basis than we do in the United States. And Europe tends to buy 2 to 3 times the amount of gold that is, taken off the market in the United States. These are places where their currencies have failed in the past. So people in India and Asia and in Europe, know that gold is an important part of their overall portfolios to protect themselves. The Taiwanese don't like they don't trust the currencies. In Vietnam, when people fled Vietnam in 75 and came to the States, they brought gold with them. That's how they got their money out of the country. And the reason they trade inversely is because if gold is priced in dollars, when the dollar gets stronger, gold becomes more expensive in other currencies. So when the dollar's high, gold becomes more expensive in other currencies. When the dollar's low, it becomes cheaper in other currencies. And it's just pretty much a price and supply and demand equation. But that's what's happened recently is the dollar has spiked and it's pushed gold down below where I think it should be. But these are previous dollar spikes. And when we have economic problems, there tends to be a flight of safety out of other currencies around the world and into the US dollar. And all of these dollar spikes, there's two things you need to remember on this chart. Most of them are when something bad happened and they didn't last that long, right? So these are classic flights to safety into the safest currency because the U.S. is full faith and credit of the U.S. government, but that's being tarnished right now to a bigger degree than we've ever seen because our debt's exploded and the world's just becoming a more divided place. But we've got the junk bond problem in '89. We've got the Mexican debt crisis in '93, the Russian default in '97, the tech bubble recession in 2000, the housing bubble peak, the great financial crisis, sovereign debt crisis, China devaluation and the global recession, and then COVID. Those are all the spikes. That's all trouble. And these things are short-lived. So when we get these unnaturally strong periods where the dollar's hot, that creates opportunity in gold and silver. And we're going through one of those phases right now. And in an inflationary environment, it's basically gold on sale. That's the way I look at it, and silver on sale.
Okay.
So this chart shows you gold's price performance since 2007 in other currencies. On the left is the US dollar, the Australian dollar, Canadian dollar, Swiss franc, Chinese yuan, euro, British pound, Indian rupee, and I can't quite see what the last one is. But you can see it's pretty much a sea of green. Now, I told you that when the US economy regained some economic traction in 2013, that was when gold came down, and that's when gold took a real tumble, about 28%. And for the next 3 years, gold was cheap. But since then, it's come back up again. 2020, gold went up 24% in US dollars. But here's the point. Over the last 15 years, in all currencies, gold has gained on average 7.5%, 8%, 8%. In British pounds, almost 11%, Indian rupees, 11%. It's gained in almost all currencies. And this is because everybody around the world is printing more money and the global debt is just increasing. They're diluting the value of their currencies. And it's not so much that gold is gaining, it's that other currencies are losing purchasing power. That's really the takeaway.
Got it. Okay. So you got some solutions for us.
Yeah. So, I Googled, a couple of months ago, what does best in inflationary periods? And you're a real estate investor. Your people are real estate people. You're very well positioned. And you feel that right now because you're able to charge more for rent, right? And the values of the properties have gone up. So things that are tangible tend to do well in inflationary periods. The things we need as the stuff of life: real estate, commodities, lumber, oil, food, corn, wheat, all these things are up. Precious metals are number 3 on the list. They don't produce anything. They don't generate income. They're not things you can eat or use to fuel your car, but they're a great store of wealth. So gold really is true portable wealth that you can carry in your hands. You can put $200,000 worth of gold in your hands like this, and I could give it to you just like that. It's portable, transferable wealth. Silver you should look at as a currency that you can spend in a crisis because its denomination per ounce is a lot lower in dollars. When an ounce of gold is $1,800 an ounce and an ounce of silver is $20 an ounce. That's how you should look at it. So having some precious metals is a good thing for most people. 5 to 10% of their net worth is really what most conservative financial planners would recommend.
Okay. So let me ask you this, Dana, because I mean, this is a wealth of information. You know, the first time I met you, I thought of you as like the gold guy, but like you know so much more information, and that's why I said I gotta talk to this guy on the show and gotta dive into some of the other things outside of gold. Even though that is really your expertise, I'm very impressed with the breadth of knowledge you have in these other areas. If you had to like look forward to the next 6 to 12 months and being in the tumultuous times we're in right now, how do you see this whole thing planning out with inflation and with the Fed interest rates and the US economy?
Well, I think that the US economy is really in a lot more trouble than most people realize right now. One of the people that we met on the Summit on Sand is Danielle DiMartino Booth, right? And she used to be an advisor to Dallas Fed President Richard Fisher.
Mm-hmm.
I started taking her newsletter, the Daily Feather, from Quill Intelligence is her service, her information service. She's got two different levels. Quill is the introductory level. She showed us on the summit how a lot of the economic metrics, the way you measure things, are rolling over, right? And one of the leading indicators are car sales. Now, we have a car supply problem right now, automobile, because of chips. But there's a lot of used cars that are starting to pile up. There's repossessions that are happening because of people use stimulus money to buy expensive cars, and now they can't afford to keep them, right? But I've had a couple of car dealer clients over the years, and they told me 10, 15, 20 years ago, when the economy starts to roll over, we feel it first, usually ahead of time. And, you know, the US economy has benefited from about 2018 to 2020 by lower oil prices, a weaker dollar, and lower interest rates. And now, since mid 2020 and up, we've seen all those things reverse. These were tailwinds that have now become headwinds. And there's a lag effect of 12 to 24 months when these things change from, you know, the interest rates bottoming and going up until we really feel it fully in the US economy. And the Fed is tightening into an economy that is clearly weakening. And this is a recipe to really make the economy go down. And I don't quite trust the great jobs numbers that we're getting out of the government. So I don't think the economy is as healthy as most people are being led to believe. That's one thing. And I really think the second half of this year could be pretty brutal for corporate earnings as well. So I think the stock market, equities markets are going to be very vulnerable, because we're already seeing layoffs in companies. You know, some of the major companies are, you know, they're not big, but it's a change of direction. They wanted everybody to hire 3-4 months ago. Now they want to let people go. Right. So I think the economic winds are going to be bad for the US economy for the next half of the year. Inflation is going to come down some because higher rates are slowing things down already. And you see it in real estate prices. Houses here in Austin, Texas, 4 or 5 months ago would sell at full ask with multiple bids, or over ask, right? The over offer price. Now they're suddenly sitting on the market for 30, 40, 50 days and there's no offers, right? Because mortgage rates have gone up. Right. So we're going to see the economy slow down a little bit because the Fed's raising rates. But inflation is going to tame down a little bit. So you're going to see all these news stories about peak inflation. We've had it. And maybe we did hit a peak this month or last month when inflation was 9% year on year. Now it's only 8.5%. Well, guess what? That's still 4 times what the Fed's 2% preferred rate is. Right. So you're going to get some false narratives in the media about how things are getting better, when really they're only a little less worse than they truly were.
They wouldn't be timing that for the 2022 elections by any chance, would they?
Well, I don't think that there's much that they can do about the red wave that's coming, because it is coming, and it's how big will it be? But I still think we're going to have a divided Congress. Joe Biden will still be president, and the Republicans may take both houses, which means we're going to get some gridlock. He'll
Yeah,
veto,
yeah,
and sometimes gridlock is good, to be honest with you. But yeah, they want to make things look good as they can for the election cycle. But the next 2 or 3 years could be really much more challenging than I think people realize. And we're just now feeling some of the pain that we're going to have to go through. And
yeah.
there was a lot of pain in the 70s, especially in that last big wave, when inflation jumped from about 6 or 8% to 17, 16, 17%.
Yeah.
And the concern is that the Fed will, this is really where things could get worse, is if the Fed doesn't tame inflation and they cave into a weaker economy and they start to either lower rates, they can hold rates the same place and see what happens without lowering them. And that may not be so bad. But if they start to lower rates and we still have inflation, or if they start to stimulate, then we could really get into a much hotter inflationary period. And that's what the Fed governors know. They really have to get the Fed funds rate over the inflation rate for a period of time to contain it. And there may not be the political will or the financial will to do that.
Well, what about, I mean, we talked a bit about the US debt at $30 trillion and the effect of this rate raising interest rates on our ability to repay that. So let's say they do get the Fed rate above the inflation rate, and our debt servicing on the $30 trillion starts to skyrocket. What kind of fallout do you think could happen from that? And do you foresee there being any risk of default or anything along those lines?
Well, we've already seen some small problems in the bond market, which is the world's biggest financing market, government to government, with the Italian debt yield spike in June of this year and the Japanese debt yield spike. And we were on the summit. Chris Martenson, Dr. Chris Martenson and I were chatting on the side, and he's brilliant in many, many fields. And I said, Chris, what are these yield spikes in the Japanese and Italian bonds really mean? I mean, the investors are shedding them, making the yields pop up. They're making the bond prices go down because they don't want them anymore. They don't trust that debt. What does it mean? He said rivets are popping within the financial system. And the ultimate source of safety and stability is the US Treasury market. And if investors start to shed US Treasuries because they're just not paying enough relative to the inflation rate, that's a problem. They barely held the financial system together when we had the great financial crisis in 2008. There was a couple of days where the system almost came apart at the seams.
Yeah.
I'm not saying that's going to happen, but the bond market is really where the problems could be bigger than we can handle.
Okay.
And it's because of the debt and the pressure that inflation is creating. Remember, they took the patient off of life support because his blood pressure went off. Now, how high is the blood pressure going to go? Can they get it back down? If they have to put the patient back on life support, that's when things could really get wonky, meaning lowering rates. So it's really going to be challenging. And I think it's going to be lumpy. And I think it could last for several years. But don't buy the short-term headline. A phrase I saw the other day, which made a lot of sense to me, was sentiment can change a lot faster than the underlying fundamentals can.
Yeah.
So you're going to see headlines are going to make us feel a little bit better, but things may not really get that much better.
Yeah.
I'm not trying to be a doom and gloomer. I'm just trying to be a realist on what could happen. Yeah. And it's because we have an over-indebted system. And now inflation's creating pressures nobody expected or saw coming 2 years ago. And it's really a lot of pressure.
Yeah.
It's
well, Well, I was glad to see real estate on your list of solutions with commodities and precious metals. I mean, that's obviously what I specialize in, and the investing in real estate is a great hedge against inflation. We've been seeing rents go up along with everything else, and that helps to provide a hedge for us. But also, investors, there's a lot of money out there, right? The investors have a lot of money, so they're still looking to place it. They don't want to leave it in cash. That purchasing power, as you alluded to, is getting eroded pretty quickly. So they are looking to invest, and I think I agree with you. Commodities, real estate, precious metals is a great place to go. So thanks for sharing all that info with us. I don't think I'll ever see you as just a gold guy anymore. You're so much more than a gold guy. But if listeners do want to get a hold of you, or they are interested in investing in the gold market, I'll put your information up on the screen one more time to have them get in touch with you, because you're a wealth of knowledge, and really appreciate you sharing it with us.
Well, thank you, Chad. It's been a pleasure to be with you and to talk to you. And yeah, it's just it's challenging times. So there's going to be some real opportunity, especially I think in real estate. But that may not materialize for another 3, 6, 9 months or a year. Ken McElroy, who's a real estate genius, was on the summit, and he said, we're just at the beginning of the cycle where prices are starting to come down, but sellers don't really want to take the lower prices yet. And that can take a year to get to where that really goes down and bottoms. And the real buys are to be had. Now, if the Fed starts to ease and prices are down, that's a great opportunity for real estate investors, because they may not be able to continue to keep rates low. So there could be a real window of opportunity coming in real estate sometime in the next 6 months to a year. So that's something your people should really keep an eye for.
We'll keep an eye on it. All right. Well, thank you, Dana. Really appreciate it.
My pleasure. And it's been great to be with you. Thanks for having me.
There's a lot to be seen over a 40-year career. Dana's done a lot more than just gold, and we're fortunate he was able to share all that with us. If you'd like to hear more from our guests, please subscribe below to CSQ Properties, and thanks for watching.